welcome to Margin of Stupidity. This is a channel where I want to share my journey of investing through multiple years, and I want my listeners and readers to understand how to make investing decisions during uncertainties. So today's topic is skepticism. Why skepticism is an investor's best edge, and why it's important, why not to get carried away by narratives. I'm going to spend the next few minutes trying to explain how to think about investing, how investing is more like poker and less like chess, just like life. Before I proceed, I want to make a disclaimer that I am a value investor and I prefer buying assets when they are cheap in price. So this kind of investing has its own disadvantages, and when markets are on a bull run, you tend to make lesser returns. So I wanted to share about something. I'm sure you must have heard of I'm sure you must have heard of the listed companies in the solar panel manufacturing and solar space. So if you look at what has been happening over the last couple of years or 3 years, there's a lot of push towards renewable energy, right? So India is moving towards energy. I mean, there is an energy transition happening where we are moving away from coal and conventional energy towards renewable energy. And in that race, what has happened is there are a lot of solar panel manufacturers which have set up large capacities. They are coming up. Some of them have listed also. Now, what this has done is last year there was a rush of IPOs, and a lot of these companies got listed in the last 2 or 3 years. I am part of some analyst communities. I'm part of some investor groups and forums, and what I see is a lot of investors, a certain group of investors, they've just been trying to explain to everyone why investing in solar panel manufacturers is a great idea. And they spend they spend a lot of time trying to convince. They have made dozens of slides, dozens of presentations, trying to make people or trying to convince people on why investing in solar is such a great idea. My question is very simple. If the idea is so good, why do you need to convince everybody so strongly? That is the first point. When you are investing in a theme which is at the peak of its popularity, the odds are anyway low, right? And here there are multiple factors at play. Here you are investing in a theme that is driven by policy support, right? Without government policy or without the support of the government, it's unlikely that this kind of investing will deliver excellent returns, because these companies are at very expensive valuation. So when you are buying at expensive valuation, you would want the growth to continue unabated for a long period of time. Something like, so then people try and bring examples of Asian Paints, or they try and bring examples of HDFC Bank. So when these companies came, and when these companies were also expensive at most of the part of their journey. However, one thing that we have to understand is these companies built very strong competitive advantage around them. They ran much faster than their competition, and they had a very long runway of growth that they could capture. No, I'm not saying these companies will not be able to do that. All I'm saying is probabilistic thinking is more important, and that is why you have to take those into consideration. And when an investor is spending, a large investor is spending a lot of time in trying to convince people, and their whole team is just focusing on creating slides on why we have bought this. So more time is being spent on convincing the investors rather than analyzing the business. So the bottom line is, a great business is not necessarily a great investment. If a mutual fund manager or if a large investor is trying to convince on Twitter or on television or social media that this is the reason I have bought the stock, and just trying to build a strong narrative around a certain company, it's better to be skeptic.
So Abhishek, why do you think a renowned investor would come to social media and pitch a particular stock?
Yeah, that's a really good question. So continuing from the previous theme that I discussed in the previous chapter. So I spoke to some analysts and I got to so continuing from the previous theme, I keep talking to analysts, and what I got to understand is certain institutional investors of a particular fund, they have been very skeptical about the continued momentum in this kind of business, where they know this is ultimately a solar company, solar panel manufacturer is ultimately a utility company, and utility companies do not command such expensive valuations over a long period of time. So these are cyclical in nature. At certain peak of the cycle, they will have good valuation, but when they are off the peak, their valuations also get derated. And their worry is we are nearing that peak of valuation. So institutional investors, they have better information, they have better analytical tools at their disposal. And that's why they have been skeptical about this. So they want to exit, or they are considering exit, and the investors know this. So they want to keep the prices up so that they can take an exit. They don't want the prices to fall when they start exiting. So you have to keep that narrative building so that at one side you have retail investors very bullish about a particular stock so that they can keep buying, they can continue to absorb the supply that is going to come from the retail, the supply that is going to come from the institutional investors. When institutional investors are selling, they're going to sell in large supplies, right? So you need certain kind of demand to absorb that supply, and that is why it's important to keep those prices up. And to keep those prices up, what do? You market, right? You do marketing, you go on social media, you go on Twitter, you build all kinds of fancy charts, fancy presentations. So that is what. I'm sure you have played poker. You're pretty good at it. So the difference between chess and poker is very simple. Chess is deterministic. If you play your moves right, you are going to win it every time you play. Right? That's it. That is what masters do. Right? They excel at their craft. But poker is not the same. Poker is probabilistic. Even if you make the right bets, there is a possibility of you losing. Poker is about improving the process so that the probability of you losing the game reduces, gets lower. Life and investing is pretty similar to poker. What you are trying to do here is you are trying to reduce your chances of making losses. So ultimately, what you have to ask is, for any asset that you are buying or any investment that you are buying, at a particular price, what is it that you are expected to get out of it? So if I'm buying an asset which is already expensive, what return am I going to get in the next 5 years? Investing is all about probabilities. It is about improving your odds of success. You will make mistakes, but the objective is to try and reduce those mistakes. If you found this useful, please subscribe to my Substack, where I share my frameworks in investing and behavioral finance.